Hey everyone, welcome back to my channel. Over the last 2 weeks, we've watched a pretty significant market recovery. The S&P 500 and the Dow Jones have clawed back most of their 2026 losses. A big driver of that? U.S. diplomatic talks with Iran, which have cooled oil prices and dragged oil stocks down with them. You can see that clearly in the VDE ETF on your screen. And here's the thing. That's almost exactly what Michael Oliver and I flagged for you last week. We told you not to chase oil stocks and to wait for the pullback. That pullback came. Now, while all of that was unfolding, gold, silver, and mining stocks just kept doing their thing. All three have outperformed the major indexes so far in 2026, and gold and silver together still hold the 62% share of value among the top 10 assets by market cap. Let that sink in. Those two metals are worth more than every company on that list combined. But let me be honest with you. There are real questions about whether this run in metals and mining stocks has legs. With inflation concerns still hanging in the air and U.S.-Iran negotiations looking shaky, some people are starting to wonder if this recent move up is just a head fake before a bigger drop. So that's what this video is going to tackle, head on. We're going to start with the long-term picture for gold and silver, using fresh data points from just this week that paint a very clear picture of what to expect over the next 12 to 24 months. That includes an affordability update, which I know a lot of you love. Then we'll zoom into the short term and talk about what to watch as we head into the April 29th Federal Reserve's interest rate decision, including the specific price floors for gold and silver, for anyone trying to time a pullback. But real quick, before we dive in, Summit Metals remains the best place to buy and sell gold and silver online. They've earned an A+ rating from the Better Business Bureau. Every product is verified 100% authentic, and if you're selling, you can trust that you'll get a fair price, which honestly isn't easy to find these days. For anyone just getting started, they're offering 3 ounces of silver at spot price with their Silver Starter Pack, 1 per household. Link is in the description below. All right, let's get into it. Most people don't realize that chasing the daily news cycle is one of the worst ways to understand where gold and silver are headed. Instead, let's look at the data, because what came out this week gives us a much clearer roadmap for the next 12 to 24 months. First up, central bank gold buying. I mentioned in my last video that this wasn't something to stress over, and that view is backed up by Joni Tevis at UBS, Switzerland's largest bank, who warned investors not to take the central bank gold-selling headlines at face value. Here's what the actual February data showed. After that sharp January pullback in gold and silver prices, central banks actually stepped up their buying. Net purchases came in at 19 tons when you account for both buying and selling. Now, yes, compared to February of last year, that number is slightly lower, and that's the headline the mainstream financial media ran with. But here's what they conveniently left out. The amount of US dollars being spent on gold by central banks is going up significantly, right alongside the rising price of gold. That's the part of the story they don't tell you, because they're in the business of selling you stocks, not protecting your wealth with physical precious metals. And this sustained global demand for gold is almost certainly part of why the US dollar hasn't performed the way many analysts expected. The dollar index is still struggling to hold above 100, down just over 2% over the past 12 months, and that's with an active conflict in the Middle East. Meanwhile, over that same period, gold is up 58% and silver is up 160%. Let that sink in. Now, on to the next data point, and this one's important. The Federal Reserve's updated its balance sheet this week. For those who aren't familiar, this essentially tracks how much money the Fed has created since it was founded and injected into the economy, primarily by buying mortgages and U.S. government debt. This past week alone, that balance sheet grew nearly $20 billion, and since December, when the Fed quietly ended its tightening program and started printing again, the total newly created money pumped into the system has reached $158 billion. That money goes to fund government expenses that can't be covered by tax revenue or borrowing. Combined with bank credit and loans, it expands the total money supply, which makes your paper currency worth less over time. The U.S. M2 money supply is now sitting at a record high of nearly $23 trillion and climbing. Pair that with nearly $40 trillion in national debt at a global money supply that is exploding across the world's 4 major central banks, and you've got a very specific environment taking shape. Add to that the fact that the market has now taken the Fed at its word. It expects rate holds, not hikes, throughout 2026, and what you have is the exact recipe for a 2008 to 2011 style bull market in gold and silver. As a long-term investor, not a day trader, I'll tell you plainly, everything that metals experts, including myself, have been anticipating is now actively unfolding. We can see this most clearly in real interest rates. That's the one-year interest rate minus CPI. Today, real interests stand at just 0.4%, the lowest we've seen since April 2023, and they're poised to go negative very soon. That right there, real negative interest rates, is the single biggest catalyst for the next major leg up in gold and silver. But here's the painful flip side of that story. For everyday Americans already struggling to save money, this is bad news. Personal savings rates are sitting at just 4%, and personal income actually fell by 0.1% in February. What that means practically is that affording gold and silver is about to get significantly harder. I've been sounding this alarm since 2022. The affordability of gold and silver has been in free fall. The median U.S. household can afford just 0.7 ounces of gold today, compared to more than 2 ounces back in 2011, which was itself the peak of the last major gold bull market.
And that's not a small difference. That's being more than 2/3 priced out in a little over a decade. Silver tells the same story. The median household can now afford just 44 ounces of silver per year at current prices versus 94 ounces in 2011. And despite the short-term headwinds I'll cover in a moment, this data makes a very strong case for staying on a consistent buying schedule rather than waiting to go all in at some perfect bottom. That magical bottom may never come, and waiting for it could leave you without the protection you need as the next wave of monetary debasement kicks into full gear. Before we get onto price floors, I want to briefly mention something I genuinely believe in. And full disclosure, I put my money where my mouth is on this just this week. I purchased a small piece of land for relaxation and preparedness purposes, and work starts this week. Owning land is just as important as owning gold and silver in my view. If you've been thinking about it but haven't known where to start, channel partner Land of Land makes it accessible and affordable. They've got properties across the country, including new lots in Colorado and Texas, many starting around $1,000. They take credit cards, they run auctions, and it's completely free to browse. Use code BALDGUY for $300 off. Link is in the description. Now, on to this week's viewer question. And remember, I answer one question every single video. Drop yours in the comments right now and it might show up in my next one. This week's question comes from Jim St. John, who asks a simple but great question. Is $4,600 an ounce the price floor for gold? Let's break that down, and we'll look at silver too. Gold in 2026 is traded as high as $5,600 and as low as $4,100 per ounce. Right now, it's sitting around $4,750, not far off its 2026 average of $5,000. But technically, it's been moving inside a wide, downward-sloping channel. You can see the blue lines on the screen. Since April 1st, we've been in the upper half of that channel, and it's pretty clear that gold is having trouble breaking and holding above $4,800. Here's my honest take. Despite all the bullish fundamentals I just laid out, I think we've got one more wave down before the real reversal begins. My window for that reversal starting is May at the earliest, July at the latest. Now, while the trading channel technically allows for sub-$4,000 gold, I want to disappoint the Gareth Salloway crowd here. I don't see a $3,500 pullback happening. The real price floor, based on the 200-day moving average, is currently around $4,174 and rising. My expected support zone sits between $4,300 and $4,400 per ounce. The worst is most likely behind us for gold, but with the Fed meeting on April 29th coming up, and with US CPI hitting 3.3% from March, the highest reading since May 2024, there's a real chance we pull back into that $4,300 to $4,400 zone. We saw something similar after the last Fed meeting when Jerome Powell rattled markets with rate hike talk. So if you're buying on a schedule, that zone is where I'd put a little extra budget to work, not going all in, just leaning in a bit more than usual. Now, for silver, the picture is a little different, and in a good way. I said back in March of last year that we'd see one more dip below $30 before we never saw that price again. What happened? Silver dipped, then ran all the way to $121 an ounce in January of this year, then pulled back to $61. Here's the thing about silver. It has a well-documented tendency in bull markets to dip just below the 200-day moving average before making explosive moves to the upside. That 200-day is currently just below $60, and I expect it to move above $60 very soon. That makes $60 very strong support. The March low of $61 is likely the real price floor, with a broader range between $60 and $71. Now, technically, we could dip below that temporarily, like we did in April of last year, which would put the absolute worst-case floor at $54.50. But honestly, I don't think the odds of getting there are low. More likely, we see a brief intraday dip below the 200-day, maybe into the high $50 in the worst case, before silver bounces hard. That would be an area I'd aggressively buy, both silver and silver mining stocks, because I don't think that window stays open long. My target for silver challenging new all-time highs remains September to October of this year. So, Jim, I hope that clears things up, not just for gold, but for silver too. Let me be clear about the big picture. Yes, I expect one more pullback, but the macro setup absolutely favors significantly higher gold and silver prices. Silver is sitting above $70 an ounce right now, a price that would have sounded like a fantasy just 12 months ago. Central banks bought the gold dip in February. Real interest rates are about to go negative, and a major monetary debasement is not a theory, it's underway. Most people don't realize that negative real interest rates were the precise trigger that launched a new gold and silver bull market back in 2002 after a 20-year bear market. The same dynamic drove the massive move from 2008 to 2011. We're at that same inflection point right now. So tune out the war headlines, tune out the noise, focus on the fundamentals, because a reversal can begin at any moment, and once it does, the window to take advantage of this pullback will close fast. That's a wrap on this one. If this video was useful to you, drop a like below. It genuinely helps this message reach more people who need to hear it. And if you've got a question you'd like me to tackle in a future video, put it in the comments right now. You never know, it might show up next week. Wishing you all a great week ahead. Take care of yourselves. Take care of each other. See you in the next one.